Many students think IAS 1 is just about memorizing the layout of a balance sheet or figuring out exactly where to drop a number on a profit and loss statement, but actually that's barely scratching the surface. Welcome to our deep dive into IAS 1. This isn't some dry, boring formatting rulebook. It is literally the bedrock, the absolute foundation of how financial transparency is achieved under international financial reporting standards. It doesn't primarily teach you how to calculate the complex accounting numbers. There are other standards for that. Instead, IAS 1 teaches you how those numbers must be structured, classified, and presented to the world so that users can actually understand and rely on them. We are talking about creating a universal financial language. By the end of this explainer, you are going to understand IAS 1 conceptually, completely, and from the ground up. Whether you're looking to tackle complex exam-style questions or handle real-world financial reporting scenarios, you will be perfectly positioned to do so. So let's jump right in and get started.
To truly understand why this standard even exists in the first place, we have to ask ourselves a fundamental question. Think about it. How could investors, lenders, or regulators possibly compare two different companies if one entity presents its expenses systematically and clearly, and the other just lists them completely randomly? Imagine you're analyzing Company A, and they meticulously break down their costs into highly specific categories. Then you look at Company B, and they just dump a single, massive number on the page labeled expenses. If you are an investor trying to decide where to put your money, or a bank deciding whether to issue a multi-million-dollar loan, this kind of inconsistent presentation creates utter confusion. You absolutely cannot compare apples to oranges. So IAS 1 steps in to solve this exact problem. It is the rulebook that arranges and presents financial statements so that everyone can understand them properly. It standardizes the language of business across the globe.
Here is our roadmap for today. We will cover why IAS 1 matters, the complete financial set, how to sort assets and liabilities, performance, equity, and notes, the essential rules, including materiality, and finally, the top exam traps.
Let's start with Section 1, understanding the core objective and why IAS 1 matters so much. The crucial takeaway here is that IAS 1 is designed specifically to prescribe the basis for the presentation of what we call general-purpose financial statements. Now, what exactly does general purpose mean? Well, these statements are directed at primary users, like existing and potential investors, lenders, and other creditors. These are people who are outside the day-to-day running of the business. They can't just walk into the CEO's office and demand custom, tailor-made financial reports. They have to rely entirely on the published statements. Because of that, IAS 1 has to guarantee two specific types of comparability. First, there's comparability with the entity's own previous periods. You need to be able to line up this year's numbers with last year's numbers to see if the company is growing, stagnating, or shrinking. Second, there's comparability with the financial statements of completely different entities. You need to confidently decide whether investing in Company X is a better move than investing in Company Y. IAS 1 achieves all of this by setting out strict overall presentation requirements, structural guidelines, and the absolute minimum content that must be included. Moving on to Section 2, let's map out the complete financial set.
Under IAS 1, a complete set of financial statements is very clearly defined. You can use the handy mnemonic SPEC to remember the 5 mandatory components. Let's break them down. First, we have the Statement of Financial Position, which is widely known as the balance sheet. This provides a snapshot of the entity's assets, liabilities, and equity at one very specific date. Next is the Statement of Profit or Loss and Other Comprehensive Income, which tells the story of your financial performance, income and expenses over the entire period. Third is the Statement of Changes in Equity. Fourth, the Statement of Cash Flows, which maps out exactly where the cash came from and where it went across operating, investing, and financing activities. And fifth, we have the Notes to the financial statements. I really want to emphasize this point because it's a common misconception. The notes are not optional extras. They are a fundamental, mandatory part of the financials that explain your accounting policies, your assumptions, and provide crucial supporting details. A complete set also absolutely requires comparative information from the previous period. Okay, let's do a quick mini-quiz just to make sure we're on track. Which of these financial statements would you look at to find the movement in share capital and retained earnings over the year? Take a second. If you said the Statement of Changes in Equity, you nailed it. That's exactly where users look to see what changed in the owner's interest during the year.
Next up is Section 3, Sorting Assets and Liabilities, which is one of the most highly tested areas in all of financial reporting.
IAS 1 strictly requires an entity to present current and non-current assets and current and non-current liabilities as entirely separate classifications. You can't just mix them all together. So, what makes an asset current? It must meet at least one of 4 criteria. Number 1, it is expected to be realized, sold, or consumed in the entity's normal operating cycle. Number 2,
It is held primarily for the purpose of trading. Number 3, it is expected to be realized within 12 months after the reporting period. Or number 4, it is cash or a cash equivalent. If an asset doesn't hit any of those 4 marks, it is strictly classified as non-current. Now, the exact same logic applies over on the liability side. A liability is current if it's expected to be settled in the normal operating cycle, if it's held for trading, or if it's due to be settled within 12 months. But there's an additional, highly critical rule for liabilities. It is current if the entity does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting date. That specific rule catches people out all the time.
Let's dive into a practical example that brilliantly illustrates the operating cycle rule. This is a concept that trips up so many students, but once you see it laid out, it makes perfect sense. Imagine we have 2 different businesses. Business 1 has a very fast, short, normal operating cycle of just 6 months. Business 2, on the other hand, operates in an industry with a long operating cycle of 16 months. Now, let's say both of these businesses have a receivable that they expect to collect in exactly 14 months. How do we classify that receivable for each business? Well, let's look at Business 1 first. A 14-month collection period is way outside of their standard 6-month operating cycle. And of course, it's also beyond the standard 12-month rule. Because it fails both tests, Business 1 absolutely must classify this receivable as a non-current asset. But look what happens with Business 2. Even though 14 months is clearly longer than a year, it actually falls safely inside their normal 16-month operating cycle. Therefore, Business 2 will classify this exact same receivable as a current asset. The golden rule to remember here is apply the operating cycle or 12 months, whichever is longer and more relevant to that specific asset or liability.
Let's test your knowledge with a classic, highly tested exam scenario. This comes up all the time. Imagine an entity has a long-term bank loan that is ordinarily repayable in 5 years. But, as with most loans, there is a condition attached. If their debt-to-equity ratio breaches a certain level, the entire loan becomes payable immediately. Now, the entity unfortunately breaches this covenant before their December 31st reporting date. Obviously, panic sets in. However, in January, which is strictly after the reporting date, management talks to the bank. The bank is understanding and officially agrees to waive the breach and defer payment for another 24 months. So the question is, how should this loan be classified on that December 31st statement of financial position? Is it current or is it non-current?
It is a current liability. This is a massive trap, and you have to watch out for it. Even if the bank completely forgives you in January, and management knows with absolute certainty that they won't actually have to pay that cash anytime soon, accounting rules require you to look strictly at the facts exactly as they stood on the reporting date of December 31st. On that exact date, because the breach had already occurred and no formal waiver was yet in place, the entity absolutely did not have an unconditional right to defer settlement for at least 12 months. The bank had every legal right on December 31st to demand their money immediately. Therefore, under the strict rules of IAS 1, it must be classified as a current liability. A waiver obtained after the reporting period does not magically travel back in time to alter the legal reality that existed at the reporting date.
Let's explore another very similar scenario. Refinancing a loan that is coming due shortly, say within 6 months after year-end. If, before the year-end date, you sign a binding agreement to roll over or refinance that exact loan with the same bank for another 3 years, you have secured the right to defer it. So in that case, it is confidently classified as non-current. But what if you are refinancing that obligation using a facility from a completely different bank? This changes everything. In this situation, the original loan requires actual settlement. You literally have to take the new bank's money and use it to pay off the old bank. Because that original underlying obligation must be settled concurrently, the original loan must be classified as a current liability regardless of the fact that you have a shiny new long-term facility lined up to cover it. Substance, legal reality, and the specific facts at the reporting date mean everything when you're applying IAS 1.
We are now on Section 4, Performance, Equity, and Notes. Let's dig into how a company presents its financial performance.
Under IAS 1, performance can be presented as one single continuous statement, or it can be split into 2 separate ones. But fundamentally, it divides performance into 2 very distinct buckets, profit or loss and other comprehensive income, commonly known as OCI. It's incredibly important to understand the conceptual difference between these two. Profit or loss captures your regular, realized, day-to-day operational performance. This is where you find your core business revenue, your cost of goods sold, your rent, your employee salaries, your depreciation, and your tax expense. It tells the users exactly how the actual fundamental business operations performed during the year. OCI, on the other hand, is entirely different. It captures specific, often unrealized items that accounting standards dictate should not be mixed in with your regular operational profit because doing so would distort the true picture of how the business is actually running. So what exactly belongs in that OCI bucket? It's a very specific, restricted list dictated by various IFRS standards. Let's walk through two of the most common examples to make this concrete. First, think about a revaluation surplus. Imagine your company bought a piece of land 5 years ago for $1 million. Today, the market value has skyrocketed to $4 million. If you apply the revaluation model, your land asset on the balance sheet increases by $3 million. But here's the catch. You haven't actually sold the land. That $3 million is an unrealized gain. If you were to drop a massive $3 million gain into your normal day-to-day profit or loss, it would make your standard business operations look incredibly, falsely profitable for that year. It would heavily mislead investors. So instead, that $3 million gain is parked safely in OCI. Another great example is the remeasurement of defined benefit pension plans. Let's say the present value of your company's pension liability was $50 million, but due to a sudden shift in actuarial assumptions, maybe life expectancy data shows people are living much longer, that liability jumps to $54 million. That $4 million increase is an actuarial loss. Because it's driven entirely by long-term statistical and demographic assumptions rather than your regular business trading performance, it is recognized in OCI. This keeps your operating profit clear of random statistical noise.
Now, let's look at how you actually present your operating expenses up in that profit or loss section. IAS 1 gives management a choice between two presentation methods, by nature or by function. Let's say we are looking at employees' salaries. Presenting expenses by nature means you just list what the expenses actually are at their core. So you would have one single line item on the statement called total employee salaries. You might have another single line for total depreciation and another for raw materials. It's straightforward. Presenting by function, however, is totally different. It takes those expenses and splits them up according to their specific business purpose or department. So you wouldn't see a single line for salaries anymore. Instead, the wages of your factory line workers would be bundled into cost of sales. The salaries of your HR and finance teams would be categorized under administrative expenses. And the commissions for your sales team would be swept into marketing and distribution expenses. Presenting by function gives users fantastic operational insight into how much different parts of the business cost to run. But presenting by nature is generally much simpler for a company to compile.
We're moving into Section 5 now, Essential Rules and Materiality. Let's review the overarching principles of financial presentation.
You can use the memory aid FGAMOFCC to keep these general features straight in your head. I really want to highlight a few of the most critical ones here. First is the accrual basis. This means transactions are recognized and recorded when they actually occur, not when the cash physically changes hands. If you owe rent for the month of December, that is a December expense, full stop, even if you don't actually write the check until late January. Next is going concern. Management doesn't just assume the business will last forever, they must formally assess if the entity has the resources to survive into the foreseeable future. If there's a material uncertainty about the company's survival, they are legally required to disclose it. And please pay very special attention to the rule on offsetting. Netting off assets against liabilities or income against expenses is strictly prohibited unless another specific IFRS standard explicitly permits it. Let me explain why. Imagine you owe a supplier $10,000, and purely by coincidence, that same supplier owes you $2,000 for a separate transaction. You cannot just net those two numbers and show an $8,000 payable on your balance sheet. You absolutely must show the full $10,000 liability and the separate $2,000 receivable. Why? Because netting them off hides the true scale of your gross obligations and distorts your future cash flow profile. Transparency is key.
Now let's talk about materiality, which is a massive concept that recently received a very important update to its definition. Historically, materiality was mostly just about whether omitting a fact or misstating a number would change a user's decision. But the new, enhanced definition says information is material if omitting, misstating, or obscuring it could reasonably be expected to influence the decisions of primary users. The absolutely critical update here is the addition of the word obscuring. So what does that actually mean in practice? It means you can no longer technically disclose something but intentionally hide a massive critical piece of information, like that major loan covenant breach we discussed earlier, by burying it deep inside 50 pages of generic, copy-pasted, immaterial accounting notes. Providing an overwhelming amount of useless, cluttered information can be just as misleading as leaving the important stuff out entirely because the clutter obscures the truth. IAS 1 demands clarity, prominence, and honesty in presentation.
Let's move to our final section, Top IAS 1 Exam Traps. We're going to review the most common places where people lose marks. Keep these 5 critical pitfalls printed firmly in your mind, whether you're taking an exam or preparing real financial statements. First, deferred tax assets and deferred tax liabilities are never, ever classified as current under IFRS. They are always, without exception, classified as non-current. Second, as we saw with our business examples earlier, you must always verify the entity's normal operating cycle before you blindly apply the standard 12-month rule to inventory or receivables.
Third, remember the strict rules of our loan breach scenario. Post-year-end waivers do not save you. If the entity did not legally possess the unconditional right to defer settlement at the exact reporting date, it is a current liability. No exceptions. Fourth, never treat the notes to the financial statements as some sort of voluntary appendix or afterthought. They are a mandatory, heavily regulated component of the complete set of financial statements. And finally, strongly resist the temptation to offset assets and liabilities, or income and expenses. Keep them separate, keep them visible, to ensure you are maintaining a fair and honest presentation of the business's scale.
Understanding IAS 1 means you now hold the keys to true financial transparency. You understand that this standard isn't just about formatting tables. It's about communicating the complex economic reality of a business clearly, consistently, and honestly to the entire world. You now know exactly how to classify current and non-current items correctly. You know precisely what specific unrealized gains belong in OCI versus normal operating profit, and you know that obscuring facts with clutter is a direct violation of materiality. So, as you face your next major exam or your next real-world case study, ask yourself this one vital question. Are the financial statements you're working on actually revealing the true economic picture, or is poor presentation just hiding the truth in plain sight? Thank you for joining this explainer, and keep mastering those accounting standards.